10 best ways to invest as a teenager. To invest as a teenager, you have to invest through a custodial account. Now, there are two types of custodial accounts, but the one you'll be interested in is called a Uniform Gift to Minors Act UGMA account. This kind of custodial account is limited to financial assets like cash, stocks, bonds, or mutual funds, annuities, and so on. The other custodial account is called a Uniform Transfers to Minors Act UTMA account. It allows you to invest in virtually any kind of asset, including real estate, intellectual property, art, and so on. All U.S. states allow you to open UGMA accounts, while you can only open Uniform Transfers to Minors Act UTMA accounts, the second type of custodial account, in some states. So you want to open a UGMA custodial account to starting investing as a minor. So how custodial accounts work? You can invest in financial assets like individual stocks, exchange-traded funds, which are ETFs, and annuities through your custodial account. Control will be transferred from your parent, the custodian, to you, the beneficiary, once you reach the age of adulthood, which is 18 to 21, depending on which state you're in. While you can't individually invest in your account, but your parents can gift funds to your account to invest. An individual can contribute up to $15,000 or $30,000 for a married couple filing jointly to an account in 2020 without incurring the federal gift tax, which is pretty important to the parents. So once the funds are in your account, you can start picking your investments. Your parents will have to make the actual trades, but you can, of course, tell them what you want to buy. Which, that's the way it's supposed to go, but you know that most people are actually just doing it themselves, right? So number one, invest in individual stocks through a discount broker. So I believe that the best way to start investing is through the stock market. The more money you have invested, the more you'll make. It cannot be understated how important investing is to building wealth and achieving financial success over the long term. Investing in the stock market through a discount broker is a popular way and one of the cheapest to invest in the stock market. A discount broker will allow you to invest in stocks, bonds, ETFs, options, and futures. It's cheaper to trade through a discount broker than a full-service broker, but they still charge fees. These fees typically range from 0.12% to 2% per trade depending on the broker. Discount brokers are best suited to people who don't want or need investment advice, trade regularly, or have small portfolios. A good stockbroker is actually Robinhood. So in fact, if you go down below and join Robinhood, you can get a free stock worth up to $500 when you link a bank account. Number two, invest in an S&P 500 index fund. This is my and billionaire investor Warren Buffett's recommended way of making money in the stock market. An index fund is a fund that purchases all of the stocks that make up an index. Some stock market indexes include the S&P 500 and the Dow 30. Investing in an S&P 500 index fund is a great way to make money on autopilot. Your money will grow by roughly 7% annually, meaning your money will double every 10 years on average, while invested in an S&P 500 index fund like iShares Core S&P 500 ETF. That includes a 4.3% dividend yield, which is the income you'll make for investing in the fund. So if you invested $1,000 in the fund I mentioned, you would receive $43 in income a year on average. The fact is that only 1 out of 20 managed funds beat the S&P 500 index on any given year. So you might as well save money on fees and just invest in an S&P 500 index fund to grow your money. Number three, invest in a mutual fund. Investing in a mutual fund, professionally managed fund, is another great hands-off way to grow your money. Mutual funds pull money from many investors to invest in securities like stocks, bonds, and other assets. Mutual funds are operated by professional money managers who often have advanced degrees in finance and economics. The manager, along with their team of analysts, allocate the fund's assets to attempt to produce capital gains and/or income for the fund's investors. Mutual funds are a big operation, but as I mentioned earlier, only have a 1 out of 20 chance of beating index funds. I believe that you're better off investing in the iShares Core S&P 500 ETF or any Vanguard index fund as well. However, I do know that some people have greater peace of mind knowing that their money is being managed by a professional. So this is another way you can go. And if anything, you should actually have money that you do it yourself, but then also have someone who guides you as well. Because there's no reason why you can't do both, right? And then you yourself can see, okay, which one was actually better for you over the long term, right? Now, the thing is, you don't give this person money, right? You basically need to focus on, let's say that you go sit down with a financial advisor and you want them to help you pick mutual funds, right? You need to understand it. At the bare minimum, you need to understand it so that you know where your money is going, because when you feel comfortable about putting your money into an investment, the better off you'll actually be, because you're less stressed out and you're not going to panic sell and try to get out of the market for no reason. Number 4, invest in stocks through a full-service broker. Another way to invest in stocks is through a full-service stockbroker. Full-service stockbrokers are a bit different from discount brokers, and they do more than facilitate the buying and selling of stocks. Full-service brokers are a better option for investors who want professional investment advice. They are more expensive, however. Full-service brokers typically charge 1 to 2% of the total assets managed annually. Buying stocks through a full-service broker is another common way to invest your money if you don't know much about the stock market. Number 5, invest in stocks through a Robo advisor. Investing with a Robo advisor is another way to invest in stocks as a newbie. A Robo advisor is basically your personal portfolio manager, except it's a software-based algorithm. The robo-advisor will automatically pick your investments, diversify your funds, and adjust your portfolio over time. These changes are all based on your chosen long-term investment goals. A great option is Acorns. It's the laziest, most hands-off way to get involved in investing. And you can download that in the description of this episode. Number 6, invest in a real estate investment trust. If you want to know how to invest in real estate when you can't afford an entire house, this is for you. And don't worry, you don't need hundreds of thousands of dollars to start investing in real estate. You can actually get started with just a few dollars. So what is a real estate investment trust, or a REIT? A real estate investment trust, or a REIT, is a company that owns, operates, or finances income-generating real estate. Modeled after mutual funds, REITs pool the capital as numerous investors. You can purchase shares in a REIT, mutual fund, or an exchange-traded fund, an ETF. Over 80 million Americans, or roughly 40% of America's households, own REITs. Investing in a REIT is a great way to invest in the property market with only a few dollars. REIT shares are priced by the market throughout the trading day, like all companies that are publicly traded. Number 7, invest in a high-yield savings account. There are more lucrative ways to start investing as a teenager, as I've explored earlier, but a high-yield savings account does have their advantages. Savings accounts are a great place to put your cash for a short period, meaning you can typically withdraw your money without incurring a penalty. So what is a high-yield savings account? A high-yield savings account is a bank account that typically pays a higher interest rate than you'd expect with banks like Bank of America. High-yield savings accounts offer the same security benefits that you'd expect from a normal savings account. The Federal Deposit Insurance Corporation, FDIC, secures the balance of accounts in banks or thrifts, and the National Credit Union Share Insurance Fund covers accounts at credit unions. High-yield savings accounts are a great way to store your money with minimal risk while obtaining a modest interest rate. And you mainly do this for just saving your money or having it as an emergency fund, right? Just to earn a little bit of extra money on it. But typically you're either putting that money in there because you're going to be buying something or purchasing something, or maybe putting that into an investment within 3 years, or you're keeping your emergency fund there. Number 8, open a certificate of deposit, which is a CD. A certificate of deposit is a product offered by banks and unions that provides a premium interest rate in exchange for you agreeing to leave your lump sum deposit untouched for a predetermined amount of time. CDs typically offer a higher interest rate than a high-yield savings account, but it can be annoying to lock your money away for 1 to 5 years. You're probably better off investing your money in a high-yield savings account if you want to be able to access your money quickly. Number 9, open a custodial IRA. Opening an individual retirement account, IRA, is another way to invest your money for the long term. Opening an IRA has several advantages. You can invest money with pre-tax income, which will reduce your taxable income, and you won't have to pay taxes on gains until you are 70.5 years old, which is a pretty long time away. Now, it's hard to think that far ahead, but hopefully this example will help. If you invested $500 a month from age 16 to 62, which is the average retirement age in the US, while growing at 7% annually, you have retired with $1,840,511. Also, something to consider is that your IRA contributions cannot exceed your earnings. For example, if you made $1,000, you can only contribute $1,000 to your IRA in that year. There's also an annual maximum contribution of $6,000 in 2020. Number 10, open a custodial Roth IRA. Another retirement account you can open as a teenager is a Roth IRA, which is highly recommended. Roth IRAs are similar to traditional IRAs, but they do have a few differences. Roth IRA contributions are made after tax, so you don't have to pay taxes on gains you make through this investment, which is great. You can withdraw money from your Roth IRA tax-free, including gains, as long as you're over the age of 59.5 and your account has been open for at least 5 tax years. You will have to pay a 10% withdrawal fee and income taxes if you make a withdrawal that is not a qualified distribution, basically anything that's not principal. So you should only invest money in your Roth IRA that you do not plan to use until retirement. Now, other taxes and fees that come with investing. Every child under 19 years old, 24 for full-time students, who files as part of their parents' tax return is allowed a certain amount of unearned income at a reduced tax rate. As of 2020, the greater of $1,100 or the sum of $350 in the individual's earned income, not to exceed $12,200, can be claimed as unearned income. Any income after that will be taxed at your parents' tax rate. Check out 40inbox.com to master your money. Personal finance lessons and courses. Want to make money online? Learn the 4 steps to make money online in the description of this episode.